Capital structure refers to the mix of debt and equity a company uses to finance its operations, each with distinct trade-offs. For example, in the 2005 Toys R Us $6.06 billion leveraged buyout, a 5-own debt-to-equity ratio was used, highlighting the benefits of debt's tax shield but also its bankruptcy risk. Companies must carefully balance leverage to optimize growth while managing financial risks. Advising a retailer, a 30% debt structure offers lower risk but reduced returns, while 75% debt increases leverage benefits but heightens bankruptcy exposure. Toys R Us fell into covenant traps by 2017, demonstrating how leverage ratios create binding constraints. With max 6.0x EBITDA limits, liquidity tests, and default triggers, declining retailers face creditor control. Strategic covenant compliance planning becomes critical as excessive leverage triggers financial distress and loss of operational autonomy. Clear method, equity versus debt control, risk, and legal implications. C. Connect to story. When PE firms face bankruptcy, they lose board control to creditors, showing how financing structures determine legal authority. L. Link to concept. Financing choices dictate control rights and legal obligations, with equity holders controlling governance pre-bankruptcy and creditors gaining power post-filing. E. Explain with examples. In bankruptcy, creditors prioritize asset recovery, taking over decision-making. For example, a tech startup nearing insolvency sees creditors influencing restructuring and asset sales. Apply to scenario. Analyze a tech firm nearing insolvency. Creditors gain control as financial distress deepens, shifting power from equity holders. Our review. In one sentence, control shifts from equity to debt holders as insolvency approaches, reflecting the risk-return trade-off in financing. Clear method, debt-to-equity ratios and legal agreements. C. Connect to story. Toys R Us's 5.1 debt-to-equity ratio became a legal tripwire, highlighting how such ratios enforce financial discipline. L. Link to concept. Debt-to-equity DE ratios and contracts act as legal mechanisms to enforce lender protections and limit risk. Explain with examples. Covenant thresholds, EBITDA adjustments, and default triggers ensure compliance. Breaching these can lead to penalties or loss of control. A. Apply to scenario. Calculate leverage ratios for a retailer to test covenant compliance under various scenarios. R. Review. In one sentence, DTI ratios in contracts can override management decisions by enforcing lender protections. Lenders use covenant breaches to gain control and fees, showing how covenants protect creditors and act as early warnings. Leverage, liquidity, and coverage covenants ensure compliance, but breaches trigger enforcement. For a cyclical manufacturer with volatile EBITDA, drafting balanced covenants is critical to protect lenders while maintaining operational flexibility. Subordination and security interests. Retail liquidations show how debt hierarchy sets payment order. Subordination and security interests establish legal priorities. Senior secured debt collateral-backed is paid first, unsecured debt second, subordinated debt last. In our retailer example, $6 bet, $3.07 B liquidation proceeds, senior secured recovers 100%, $3.02 B, unsecured 25%, $0.05 B, subordinated 0%. Subordination enforces payment hierarchies in distress. Let's talk about the preferred stock and legal rights with the clear method. Preferred stock offers protections above common equity but below debt with distinct features. C. For example, P firms' preferred rights were wiped out by senior debt in bankruptcy, showing the risks of subordination. L. Preferred stock often includes liquidation preferences, cumulative dividends, conversion rights, and veto rights to protect investors. E. To design preferred stock for a software firm, include a 1.5x liquidation preference, cumulative dividends, and veto rights while modeling exit scenarios. A. Ultimately, preferred stock ranks above common equity but below debt in recoveries. Convertible securities blend debt and equity, creating legal and valuation complexities, especially in distress. C. For instance, PEAK notes and convertibles have led to disputes in bankruptcy due to their hybrid nature. L. These instruments include features like PIK toggles, conversion options, and classification challenges, which complicate their treatment. E. To analyze a convertible bond in bankruptcy, assess its debt-equity split, seniority, and conversion value under different scenarios. A. Ultimately, convertibles introduce unique legal and valuation challenges in financial distress. Capital structure in distress. C. Bankruptcy with the clear method. In bankruptcy, a retailer's capital structure sets the legal recovery order: DIP lenders first, then secured creditors, then unsecured with equity last, guided by the absolute priority rule.